All right, so you're looking at STEM, and that share price is looking pretty tempting right now, isn't it?
It is.
Under 0.34. You've got insiders buying, and a whole energy software market that seems like it's about to just take off.
Yeah.
Think about maybe a buy and hold strategy. Play the long game.
Right.
But the question is STEM really set for growth?
Right.
I mean, we've got earnings reports, we've got analyst chatter, and we've got your notes to go through.
Yep.
So let's see if we can figure this out together.
Mm-hmm.
Is this a hidden gem, or is this a potential pitfall?
I think the real question here is if the market is undervaluing STEM's potential. They are making a pretty big move, shifting away from low-margin hardware and focusing on software and services,
Right.
which could be huge in this evolving energy landscape.
Yeah. Okay, so let's get started with those recent earnings reports. Dismal doesn't even come close, right?
Yeah.
Q2 and Q3 were way below expectations, and there was a 78% year-over-year revenue drop in Q3.
Yeah.
I mean, we're talking about a stock that was $47 at its peak in 2021,
Yeah.
and now it's struggling to stay above $1.
Yeah. You have to keep in mind that a big part of that revenue drop is directly related to selling less battery hardware. And remember, they're intentionally moving away from that low-margin business. But yeah, there's no denying they've hit some snags along the way. Project delays have been a major headache for them.
Yeah, and it looks like it's been impacting the entire renewable energy sector.
Yeah.
From what I see in the reports, the bottlenecks with USDA funding for public power projects, those PACE and New Era programs specifically, are causing a lot of uncertainty.
Yeah.
Plus, interconnection approvals are taking forever. And sourcing high-voltage transformers from anywhere but China is a nightmare right now.
That's a really important point. Those delays are largely external factors, things that are outside of STEM's control.
Right.
And it really highlights the wider challenges of transitioning to clean energy, and it adds another layer of complexity when we're trying to assess STEM's future.
Yeah. And we can't forget about that huge $104.1 million bad debt expense they reported in Q3.
Yeah.
Those customer contract guarantees for hardware resales seem to have really backfired.
It definitely raises some questions about their previous business model. I mean, those guarantees were designed to incentivize hardware sales,
Yeah.
but they've ended up being a liability in this volatile market. And I think that underlines why they're making this shift to software and services. And to really understand this pivot, we need to dig into what they keep referring to as CARR and ARR.
Okay. Yeah, those acronyms are popping up everywhere. And honestly, I think I need a little refresher on what they actually tell us about the company. Can you help me out here?
Absolutely. So CARR stands for Contracted Annual Recurring Revenue. Think of it as the total yearly value of all of their signed software service contracts,
Okay.
including those for systems that aren't even operating yet.
Okay.
ARR, which is annual recurring revenue, is a little more conservative. It only includes revenue from active systems that have actually been commissioned. So CARR represents the potential, and ARR shows us the current reality of their recurring revenue.
So if their CARR and ARR are both growing, that means they're building a solid foundation of recurring software revenue.
Right.
And that's exactly what they're aiming for with this strategic shift.
Exactly. And we are already seeing some positive signs. They hit record high gross margins in Q3, 21% on a GAAP basis, and a whopping 46% non-GAAP. And that's a direct result of focusing on software and services, which have much higher profit margins than hardware.
Okay, that's starting to make sense now. So it sounds like the market might be too focused on the shrinking revenue from hardware, and they're not really grasping the significance of this margin expansion.
Right.
But even with a solid software strategy, can STEM really compete in this space?
Yeah.
Are they a leader, or are they playing catch-up?
Well, this is where things get really interesting. The utility-scale energy software market is projected to just grow exponentially in the coming years, driven by factors like the increasing need for energy storage, regulatory support for renewables, and the rise of AI in managing energy assets. And STEM, with their Athena software platform, is not just a player in this market. They're recognized as the largest storage virtual power plant operator in North America, managing over 3 gigawatt hours of capacity.
Wow. So they're not just keeping up, they're actually ahead of the curve?
Yeah.
That definitely changes things. But some of these analyst reports are projecting 61% annualized revenue growth for STEM through 2025. That seems really optimistic, doesn't it, given their current struggles?
It's a bold prediction for sure. Analysts are essentially saying that STEM is going to blow past the industry average growth rate of 8.4%.
Wow.
And it really hinges on their ability to successfully implement this software-centric strategy.
Okay, so we've laid out the context. The challenges and the potential. Let's dig a little deeper into this insider buying that we talked about and those leadership shakeups. Could those be the missing pieces that help us figure out if this is a buy and hold opportunity or a risk not worth taking?
Let's delve into that next. We'll look at what those insider purchases tell us about internal sentiment,
Okay.
unpack the implications of those leadership changes, and then we'll try to tie it all together
Okay.
and see if we can answer the question that brought us here. Is STEM poised for a comeback? Or is it too early to tell?
So let's talk about these insider stock purchases. You mentioned they're snapping up stock, but what does that really mean?
Well, on November 1st, there were some pretty significant grants of restricted stock units,
Okay.
or RSUs,
Right.
to several key executives. And these RSUs vest in November 2025,
Okay.
which is interesting. It suggests a longer-term outlook. Buying stock at a low price and hoping for a quick turnaround is one thing.
Hmm.
But being granted stock that you can't fully access for another year,
Right.
that seems to indicate a belief in the company's ability to turn things around over time.
So they're putting their money where their mouth is, but with a delayed gratification twist.
Exactly.
So who are these insiders?
Yeah.
And are they directly involved in this software pivot?
Absolutely. Michael Carlson, the chief operating officer, received 175,000 RSUs. Albert Hofelt,
Okay.
the new chief technology officer, received a whopping 275,000. And remember, he's the one tasked with leading the development of enhanced AI-enabled software and edge device capabilities, a core part of their new strategy. And then there's Kim Homenok, the chief people officer, and Matthew Tappan, the president of the software division.
Okay.
Both received substantial grants as well.
So it's not just any insiders, it's the key players driving the software strategy. Which does seem to add some weight to the idea that they believe in this shift. But we also can't ignore these leadership changes.
Yeah.
A new CEO in September, now a new CFO coming in.
Right.
That level of turnover at the top can be a little unnerving.
It's true that leadership changes can signal instability sometimes, but in this case, it might be more of a necessary course correction.
Yeah.
I mean, the previous CEO was at the helm when those hardware guarantees were implemented,
Right.
and the stock price plummeted under his watch. This new leadership team, including the new CFO and the new CTO, seem very focused on the software and services strategy,
Right.
and they're bringing fresh perspectives and expertise at a very crucial moment.
It's almost like they're hitting the reset button, acknowledging that the old approach wasn't working, and now they're assembling a new team to execute a new game plan.
Precisely. And it's not just about personnel changes. They're also undertaking a formal strategic review of the business.
Yeah.
They've even formed an ad hoc software strategy working group to focus on this software pivot.
Okay, so you've got these seemingly conflicting signals. On one hand, terrible earnings, a falling stock price, and leadership changes, which usually scream, danger, stay away. But on the other hand, there's this strategic shift towards a booming market insider buying and a renewed focus on what seems to be a solid long-term plan. It's enough to make your head spin.
That's the challenge, right? Investing is rarely black and white. There's always a degree of risk and uncertainty. The key is to weigh the potential rewards against the potential downsides.
So let's go back to the original question.
Yeah.
Buy and hold STEM. Or is it too risky?
Yep.
What are your final thoughts?
Okay, let's recap. STEM is operating in a sector with enormous growth potential, and they're arguably a leader in this space.
Right.
Their shift to software and services is already showing positive signs in terms of margin expansion,
Okay.
and they have a dedicated team focused on executing this strategy. However, they're also facing some headwinds from those external factors like the project delays that we talked about earlier,
Right.
and their financial performance is still a bit shaky.
It's a gamble, but potentially a very rewarding one. What would you say to our listener who's considering this buy and hold strategy?
I would say STEM is not for the faint of heart.
Yeah.
It's a high-risk, high-reward proposition. If you're looking for something safe and predictable, look elsewhere. But if you are willing to tolerate some volatility and you believe in their long-term vision, STEM could be an intriguing opportunity.
I think that's a great way to put it. It all comes down to understanding your risk tolerance and making sure that your investment strategy is aligned with your overall financial goals. Now, before we wrap up, I actually found one more little nugget of information that I think is pretty relevant to this discussion. So remember how we were talking about STEM's market cap taking a pretty big hit?
Yeah.
Well, it wasn't just the falling share price.
Right.
Their total assets were almost cut in half in Q3, going from $1.3 billion down to just about $500 million. That's a massive reduction.
Right.
And it kind of makes you wonder about their current financial situation.
It's definitely something to think about. I mean, seeing such a significant drop in assets does raise some questions. But it's important to remember that STEM is intentionally shifting away from hardware and focusing on software. And that could explain at least part of this decrease. It's also worth noting that their liabilities have decreased as well, which
Right.
suggests that they're trying to be more financially prudent as they manage this transition.
I see what you mean. But I have to admit, even if it's intentional, a drop that big still makes me feel a little uneasy. It's like watching a huge chunk of your savings just disappear.
Right.
Even if you knew changes were coming, it's still a bit of a shock.
I understand your concern, and it's a good reminder that even with all the potential upside we've talked about, there are always risks involved. And that's why thorough due diligence is absolutely essential. You really need to take a closer look at those financial statements,
Yeah.
scrutinize those debt obligations, and try to understand how those project delays might impact their cash flow. Those are all pieces of the puzzle that will help you paint a clear picture of their overall financial health.
So it sounds like there's still a lot to consider before making any decisions.
Yeah.
It's easy to get caught up in all the excitement about this booming energy software market and all of STEM's ambitious plans. But these financial red flags definitely make me think twice. What would you say is the biggest takeaway for someone considering investing in STEM right now?
I think the most important thing is to approach this with a healthy dose of skepticism and a critical eye. Don't let the hype surrounding the sector or the company's vision cloud your judgment. STEM is operating in a really exciting space, but they're also facing some real challenges. And successful investing requires you to balance your enthusiasm with thorough analysis and a careful assessment of potential risks.
You've definitely given me a lot to think about. I came into this deep dive kind of hoping for a clear-cut answer, but it seems like there's no easy solution.
Exactly. There's no magic formula when it comes to investing, and there are no guaranteed outcomes. Weigh the potential rewards against the risks. Do your own research and make an informed decision that aligns with your personal investment goals and your risk tolerance. Remember, even if STEM doesn't become the success story that you're hoping for, this deep dive has hopefully given you some valuable insights and tools to help you make better investment decisions in the future.
Well said. Thanks for joining us for this deep dive into STEM.
Huh?
We've covered a lot of ground, explored the company's challenges and opportunities, and hopefully you now have a better understanding of what's going on. Ultimately, the decision of whether to invest is yours. But informed investors make the best decisions.
Absolutely. Keep learning, keep exploring, and keep those critical thinking skills sharp. Until next time, happy investing.